How would you feel if you got a letter in the mail from your bank in which you were expecting to open it up and see your statement showing how much interest you earned, but it was in the reverse, where your bank actually started charging you for you to park your funds there? Over here in America, that's something we're not used to, but over in the European area, it's been going on for quite some time now, and more banks are starting to implement it and roll it out to their depositors. And in my personal opinion, it's not too far-fetched to think that it won't be coming here to the USA. Let's talk about this. So I came across this article here on Wall Street Journal, and it came out yesterday, and I thought the title in and of itself was worth bringing to your attention, just because everything we're experiencing now in the financial realm is about protecting the current banking paradigm. And so all the monetary policy we're experiencing is geared towards making sure that too big to fail banks are not exposed for being insolvent and the primary catalyst for all these financial issues we're having in this current economy. So I want to thank you for taking the time to click on this RTD quick take. And I want to remind you guys, if you're interested in seeing more videos like this, short and sweet, straight to the point, giving you something to think about, make sure you guys hit that thumbs up button, as well as subscribe if you're new to the channel. And if you want to make sure you're notified, more than likely you may not get notified via the bell notification. So I want to encourage you to join the RTD email list, where I send out email notifications prior to going live for the live streams in the evenings. And then if you want to connect with the community beyond just these videos here, I'd encourage you to do so by joining the social media tab beneath this video here. Click on the Discord page and feel free to share articles and videos from your favorite content creators throughout the day, and during the evenings we'll touch on those stories during the live stream. So here we have it. Banks in Germany tell customers to take deposits elsewhere. And the reason I thought this article was worth bringing to your attention is because there's a lot we can learn from within this. And so not only has every nation around the world experienced issues relevant to ours, but I think Germany is a unique situation because they've been dealing with banking issues for quite some time now in regards to Commerzbank as well as Deutsche Bank, which are the two banks that this article happens to shine light on. But yet the one thing that separates them from us is the fact that they are currently living in an environment where they actually have negative nominal real interest rates, which means the idea of paying their banks to park their funds there is nothing new to them. But one of the biggest issues is that whenever they actually roll out some type of adjustment, it always starts with those who have the most parked in those banks, and it spreads all the way down to the person that has very little. Yet, even though here in the US, we're not in actual nominal negative interest rates, when it comes to parking our funds in our banks here domestically, in reality, we're not much better, because our real interest rates, when you take into account what you're being paid to park your funds in your bank now, in comparison to what we're being told is the actual rate of inflation, we are in the negative. And so to give you a little bit of a backdrop as to how Germany in particular arrived at this situation here, as you can see on this chart here, going back up to 2014 is when this article really highlights how commercial banks passed on the cost of depositing funds into their institutions onto their depositors, as opposed to it being the other way around, where the whole purpose behind parking funds into commercial banks is the fact that you're a creditor, that you're lending your currency to them. But yet in Germany in particular, in 2014, when they went from 0.2% interest from the European Central Bank all the way into 2015, where it actually went down to zero for the most part, that was a turning point for that economy there, where the high net worth individuals were then charged to park their funds in the banks over in Germany. Since 2015 all the way up to this current moment, they've been in negative territory, and the threat on having too much cash parked in banks has spread from the ultra wealthy all the way down to your ordinary saver. And what makes this situation so unique is the fact that Germany, out of all the countries in the ECB, happens to have the highest savings rate. And so as you can see on this graph right here, from the same time frame I highlighted on the interest rate chart, from 2014, citizens in Germany began slowly to increase their savings as the years went on as a result of the whole great financial crisis with the erosion of monetary policy in the ECB. But as you can see throughout the years, increase in savings have been steadily creeping up until, of course, last year, where we all experienced the complete lockdown of economies, where it all of a sudden spikes up to 20%, back down, and at this current moment, they're approximately just shy of 18% of the savings ratio amongst the total population there in Germany. And so, of course, both of these graphs, whether it's this one or this one here, they both resemble things that we're experiencing here in the US. Near zero interest rates and all-time high in savings rates. So here's the actual article here. I'll put it up on the Rethinking the Dollar blog site just because I was actually able to find a full-length version of the article to thumb through. But there's a couple things I wanted to pull out here that I think can further highlight how, even though they are in real negative terms, in actuality is no different than us being over here where we're in real negative interest rate territory, which is the same as them. And so scrolling down, here's a couple of things I highlighted here that I thought would be worth bringing to your attention. And as it says here, interest banks have been negative in Europe for years, but it took the flood of savings unleashed in the pandemic for banks finally to charge depositors in interest. It says Germany's biggest lender, Deutsche Bank and Commerzbank, have told new customers since last year to pay a 0.5% annual rate to keep large sums of money with them. The banks say they can no longer absorb the negative rates the European Central Bank charges them. It says that is creating an unusual incentive where banks that usually want deposits as an expensive form of financing are essentially telling customers to go away. And so once again, because the ECB and their fight against deflation as a part of their monetary toolkit over there, they've been lowering interest rates to the point to where now it's negative, which allows them to pump all types of quantitative easing and QE into their monetary system the same way they're doing here. And ultimately it comes back to hurt the commercial banks because it disrupts the whole banking concept of being able to park funds and have them grow over time when you're in a negative environment, because those type of policies are intended to be incentives for people to borrow and not save. It says the pandemic has changed the equation. Saving rates skyrocketed with consumers at home, and huge relief programs from the ECB have flooded the banks with excess deposits. And then here's a good example as to a person who received one of those letters in the mail telling them that they now had to pay to park their funds in the bank because of the current environment. So here's a guy named Alexis Birius, if I'm not pronouncing that incorrectly. It says a managing director at a fintech company received a letter from his bank, a unit of Commerzbank, last year saying it was going to start charging him 0.5 interest on deposits above 100,000 euros, or the equivalent of 121,000. It says to avoid paying, Mr. Beers, whose savings ballooned without trips to the restaurants and vacations, shifted some 60,000 euros to a bank in Italy and one in Sweden through an online platform called Raisin, which allows customers to shop for better rates at banks across Europe. And he's quoted as saying, "I wouldn't mind receiving nothing for my deposit, but being asked to pay is just too much," the 34-year-old said, adding that he plans to use the money to buy a house before the birth of his second child this year. And then here it says, according to the price comparison portal Verivox, 237 banks in Germany currently charge negative interest rates to private customers, up from 57 before the pandemic hit in March of last year. It says charges range between 0.4% and 0.06 for deposits, beginning anywhere from 25,000 euros to 100,000. And so here you have the fact that since the lockdown last year, more banks in Germany are being forced now to pass on the cost of parking funds in their institutions onto the actual depositors themselves, which totally distorts the idea of parking funds in a bank, or actually lending them or supposedly lending them to the banks themselves. So this current environment we're in now has completely disrupted the whole concept of savings and the role of banks. And that's why a lot of people believe that the banks are dead, the banks are no longer needed. And especially you have the blockchain cryptocurrency space now, where more people are excited than ever to actually leave the banks so that they can become their own bank by taking responsibility upon themselves and handling their own finances. And then scroll down here, it's just not Germany. It says in Denmark, where interest rates were cut to below zero 2 years before the Eurozone, banks have gone from charging wealthier clients to smaller ones all over the past year. And so there you have it. I thought I would just take a minute to share with you this article here to highlight what's going on in Germany at this current moment. And then also to piggyback on the fact that even though here in America, we are not in nominal negative territory, we do have real negative interest rates when it comes to the lack of interest you receive on your savings and checking in your local bank, no matter where you're at in the US on average. And so unless you actually have gone out to find a bank that offers you something above the rate of inflation here, you're actually in real negative territory. And the best way to calculate that is basically to take the numbers that they give us, which according to the Bureau of Labor Statistics, we're approximately 1.5, 1.6 is the rate of inflation. And of course, we know that Jerome Powell and the Federal Reserve, they're trying to shoot above 2% inflation and average above 2% inflation moving forward for the next couple years, while the actual rate that your bank pays you for you lending them funds is approximately 0.1% or around that territory, which in its current environment, it's the lowest it's been for sure. And there's no way that it can increase, because if it does increase, that will further hurt the banks. And of course, everything I mentioned as I started off was basically to highlight the fact that everything we're experiencing in the financial realm is about the banks in and of themselves. Just look at the great financial crises that happened a decade ago, where the whole goal was to keep the system afloat by bailing out the banks. And of course, that was supposed to solve the problem. But as we're witnessing now, it did not. It only kicked the can down the road. So here we are now in this current environment where the banks are not being exposed for being the problem. But yet when you look at the fact that credit cards aren't being paid, commercial mortgage-backed loans are not being repaid, mortgages are not being paid, who issued all that debt? It's the banks themselves and other financial lenders. And so they are in trouble, believe it or not. So the likelihood of them ever wanting to pay you more for parking your funds there is not happening. And so you take that current level of inflation of 1.6, 1.5, whatever they tell us it might be, and you subtract it from the level of interest you're being paid right now when you look at the bottom of your bank statement, and that's the real rate of return you're receiving at this current moment. And unless you purposely went out there to find something above that 1.6 level of inflation to receive an interest from your savings, then you are definitely in real negative terms. Once again, that's my 2 cents on what's going on here. But I think it's a real eye-opener to realize that unless you're purposely out there placing your currency in a position where it's working for you, more than likely if it's parked in one of these banks, even if it's a credit union, more than likely you're probably in real negative interest rate territory. So what does it boil down to? What's the solution? In my personal opinion, of course, do the best you can to limit your exposure to these commercial banks, because one day pretty soon there will be another banking crisis, and this next banking crisis, in my personal opinion, will be the catalyst that they use to transition us out of the whole physical banking model according to the way it has been in the past, with you actually holding cash and your coins in banks, into this central bank digital model that they're wanting to steer us in the first place, where there may be limits on the amount of cash you can receive from the bank as well as coins. So just something worth thinking about. And of course, if you're a part of this community, you know my motto: get your weight up. If you go back in time and you look at how banking originally started with the idea of a goldsmith, where people would put their metals in the hands of a metal worker to make jewelry, utensils, as well as all types of silverware and things like that. But yet we've come a long way from that to the point where now it's paper and digits in the hands of some really big banks that are labeled as globally systemic important banks. And so there we have it. It doesn't take the Federal Reserve to actually take us negative for us to experience the side effects of being in a negative environment, just because parked funds do not grow in this current environment. And in my personal opinion, that's not a part of their game plan either. So once again, thanks for taking time to watch this. I'm curious to hear what you think on this. Would you be surprised if you got a letter in the mail saying that your bank was actually going to be charging you on top of what the monetary policy is charging in the form of negative rates? I'm curious to find out. And if you've enjoyed this, definitely hit that thumbs up button. And if you're new to the channel, subscribe. Looking forward to bringing you more of these quick take updates. And other than that, looking forward to seeing you on the next video. Enjoy your day.